I've been selling tech. I don't think we're done yet.
The risk is that the bond yield just keeps going up. If it just keeps going up and up, that could create a whole new set of problems for the economy.
If rates continue to go up, I think that long duration assets are going to struggle a little bit, and that does include tech.
Wherever the U.S. equity market goes for the second half of August, a lot will likely depend on the direction of mega caps.
The CPI last week on Thursday, excluding shelter, it was up 2%. And if you take the core CPI, it was up 2.5%. So we're already on that basis awfully close to the Fed's target of 2%. All we're really waiting for is for rent inflation to come down. Everybody knows that that's a bizarre lagging indicator of rents. Everybody knows that the Zillow index, the apartment list index, inflation rates have come down dramatically. So I think it's pretty much locked in. It's baked in the cake that we're going to see lower rent inflation, and that should offset some of the increases that we might get in oil prices. But I think overall, we're still looking at a disinflationary trend.
The notion of cuts, are you on board with that? And can it happen less from sort of emergency reaction and more to how real rates have become maybe too restrictive?
The John Williams interview that occurred August 2nd, he said something extremely important. He focuses on real interest rates, not nominal interest rates, and what he thinks is that if inflation continues to moderate, that the Federal Reserve will have to lower interest rates. Otherwise, they're going to be increasingly restrictive. So I think they're already putting out there the idea that interest rates will be coming down next year if they continue to achieve their goal of moderating inflation. That's an extremely important message to get across to the bond market, because I think their number one risk now is that the disinversion that occurs in the yield curve occurs in an unusual fashion. Usually disinversion in the yield curve occurs as we get a recession, short-term rates come down and bond yields come down, and that turns out to be a good bullish optimistic scenario for the market. This time around, the risk is that the bond yield just keeps going up. As you see, we're at 4.2%, and if it just keeps going up and up, that could create a whole new set of problems for the economy. There's two disinversion scenarios, as I just suggested. One is where short-term rates come down and long-term rates come down, but short-term rates come down faster. The other disinversion scenario is not a happy one. It's a bearish, pessimistic one, where the bond yield keeps going up, moving up to where short-term rates are, and short-term rates are pretty close to 5%. And seeing the 10-year bond yield go from 4 to 5% would be pretty difficult for the banks. As it is, we already have a banking crisis. Moody's has downgraded the banks. It would mean more losses in their portfolios and perhaps shake up confidence in the banking system. So they don't want to go there. And then that would play, of course, on the commercial real estate market. Still higher mortgage lending rates in that market would be a disaster. It's already sort of a semi-disaster, would be a complete disaster. John Williams is trying to kind of calm everybody down and talk down the bond yield from really spiking up here.
Is the pullback that we've seen in the NASDAQ enough? Is it done? I think it's getting close, in particular for technology. Semiconductors, obviously, with NVIDIA, with the analyst note today, is getting a nice, strong bounce back recovery. But over the last couple of weeks, I've heard from so many people that, yes, in fact, the rally can continue without the participation of mega caps and technologies. Unfortunately, statistically, that's not actually what's unfolded when you see names like Microsoft down 5% month to date, Apple down 7% month to date, and you see the semiconductors down just as much. So it's good to have the return once again of semiconductors today. I certainly would not be selling expecting a more significant correction. Is there prudence in waiting for what the earnings is going to be for NVIDIA? Yeah, I think so. I think if you have a position, you kind of sit with it, you wait to hear what's going to go on. Bespoke talks today about whether the overall rally needs tech and to what degree it does. Bespoke says wherever the U.S. equity market goes for the second half of August, a lot will likely depend on the direction of mega cap stocks. You agree with that?
I do, because it's such a big component of the S&P 500, right? I mean, tech and comm services is 35% of the S&P 500, so you need that participation. That's why I think we have seen the markets kind of just be a little bit volatile and kind of in a trading range over the last couple of weeks because these stocks have all pulled back.
You guys made the argument, though, that you don't, like the other areas of the market are fully capable of picking up the slack. You guys have made the case that you don't necessarily need tech. Now you're telling me you do.
I think you can have some parts of the economy, the markets do better, and that could help the markets not totally collapse. But I do think you need some participation in tech overall. It's just too big, right? That being said, I don't think, I've been selling tech. And I don't think that we're done yet. Some of these stocks are still up quite a bit. The big 6, 7 are up anywhere from 30% to 191%, trading on an average of 34 times forward estimates.
Wait, you just say you don't think we're done yet in terms of selling on the mega names?
Yeah. Yeah,
Wow.
because they're still expensive. They're up so much. They're definitely not in the value camp. And if you have rates continuing to rise, which we have been, especially after the CPI print last week, which didn't really show a lot of progress, some progress, but not a lot of progress. If rates continue to go up, I think that long duration assets are going to struggle a little bit, and that does include tech. So I'm not saying there's a major collapse in the market. I think you're going to be volatile for the next month or two. Seasonally, that makes a lot of sense as well. And then I just look at some of these stocks and what they have done.
Well, I mean, I'm looking at the forward PEs of the stocks as we're filtering through the names here, right? Apple, which had a plus 30 forward PE, is now 28. NVIDIA, for example, which was at 62.5 in May, is now down to 46.5.
What are you getting at Apple in terms of total earnings growth and revenue growth? You had iPhones down 2%. Fine, I'll give you services. That was actually really the bright spot at 8%. That's only 25% of their business.
Yeah, I know, but
so 28 times for that kind of growth, Scott, is not attractive to me. And a lot of people are in this name. It's 7% of the S&P 500. And I just think people will take some profits.